Hi, guys. I'm Lynn, and this is my co host Prim. Welcome to True Financial Stories.
Tonight we have a special edition showing our very first top rogue traders episode. These traders have collapsed the world's leading banks.
These rogue traders have used derivatives such as options and futures to commit fraud in the financial transactions. So, before we move on any further, we must first understand the concept of derivatives. So, what are derivatives? Derivatives are simply securities whose value varies depending on the fluctuation of its underlying assets. The most common underlying assets include stocks, bonds, commodities, and currencies. Therefore, most derivatives are characterized by its high leverage. To give a clearer picture, consider an example of Miss A and Miss B. Suppose the current market price of Miss A's gold watch is $100. However, Miss A believes that the watch company will launch a new model by the end of the year, which lowers the value of her gold watch. She then decides to sell the watch for $100 by the end of the year. On the other hand, Miss B has an opposite opinion. She is convinced that the company will not launch a new model, which conversely will lead to an increase in the value of the gold watch. At this point, both parties have entered a derivatives contract, which will obligate both buyer and seller to make a transaction at a pre-specified date and price. In this case, $100 for the gold watch by the end of the year. Furthermore, derivatives can come in several forms such as forward, future, and options. For forward and future contracts, they have a lot in common. Both contracts obligate the holder or parties, long and short, to make a transaction at predetermined date and price, just like the example given earlier. However, forwards are traded over the counter while futures are traded on the exchange market. On the other hand, an option contract is different. For option contracts, the contract only yields a right for the holder to either make or not make a transaction in the future. Thus, it gives the flexibility to the buyer compensated by a premium paid to the writer of the option. With the basic understanding of derivatives, now you may wonder why the bank is in need of a trader who, later in the episode of True Financial Stories, turned rogue. In order to give a clearer picture, consider the bank's role in the financial market. Banks normally act as an intermediary for moving capital from one with surplus to another with a shortage. They make money by having the spread in the interest charged and interest paid. But is this a significant amount for the bank? The answer is no. Typically, there will be a mismatch between borrowing and lending, which creates a surplus within the bank. Therefore, they hire traders to trade on their behalf in order to generate more money, both to match the principal and to increase the bank's bottom line, placing the traders in perfect position to turn rogue by taking advantage of their position in the bank. So now, after finally understanding the concept of derivatives,
Let's get to know our rogue traders.
Born on February 25, 1967 in Watford, United Kingdom, Leeson grew up in a working council estate and attended Parmiter School in Garston. Although being considered a poor mathematician by his teachers and graduated with a few qualifications, he always had high aspirations for himself. In 1985, despite having no financial background or experience, Leeson landed a job as a clerk at the Royal Bank, Coutts. After 2 years, he moved to Morgan Stanley and finally ended up working for Barings Bank in the year 1989. Barings was the oldest investment bank in the United Kingdom and furthermore was also a personal bank to Her Majesty the Queen. At Barings, Leeson worked his way up and was soon promoted to the trading floor. By the year 1992, he was promoted to general manager of a new operation in futures markets on the Singapore International Monetary Exchange, SIMEX. By that time, Leeson and his wife were living a life of luxury, with his £50,000 salary and bonuses of up to £150,000. As soon as Leeson started trading in Singapore, he has engaged in various unauthorized activities. These unauthorized activities included going long on SIMEX with approximately the same number of contracts when he was supposed to short. What leeson did was sold straddles, or selling one put option and one call with the same strike and maturity. This benefits the seller if the price don't change much. For example, in the case that the option expires worthless. Without any authority to sell such options, leeson still managed to sell over 37,000 straddles in the period of 14 months, and had earned a premium from it. At this point, the losses had piled up, and leeson decided to move away from Barings the moment he realized the losses he has caused. During this time, he tried to sustain the market by buying huge amount of Nikkei stock index futures and sold JGB futures in hopes that the interest rates would rise. All of this was hidden through using the infamous 5/8 error account that was not monitored. The 5/8 error account was not known to the UK senior management team. leeson engaged in large volume of cross trading between the 5/8 error account and other accounts. This was done by matching positions of the two accounts belonging to the same client. For example, if Barings owed $500 million to Daiwa Bank from one type of transaction, but also expected to receive $300 million from Daiwa from another type of transaction, it could net the two amounts through a cross trade. After executing these cross trades, leeson would instruct the settlement staff to break down the total number of contracts into several different trades, and change the trade price to cost profit to be credited to account 92,000, while charging losses to account 5/8 account, so that what appeared to be an arbitrage was in fact a speculation, disguised with the help of account 5/8. In the end, leeson, taking advantage of the big positions the Barings had to bet against the firm, had led to the fall of Barings with $1.4 billion worth of losses, due to the bank not being able to meet its obligations.
Lastly is our final rogue trader for today, Jerome Kerviel. Jerome Kerviel is a French trader born on January 11, 1977 in Pont-l'Abbé, Brittany, France. His childhood friend said that Kerviel wasn't in the financial business for fancy cars and clothes, but for his interest in the financial markets and how economics work. In the year 1999, Kerviel graduated from the University of Nantes with a degree in finance, and in the year 2000 he completed his master's degree in finance at the University of Lyon and started working at Societe Generale. Kerviel's job at Societe Generale involved making plain vanilla hedges on European stock market indices within the equity derivatives divisions, the bank's most profitable operating unit. By the year 2005, Jerome Kerviel began exceeding the maximum transaction size and began engaging in other unauthorized transactions. He learned several different ways to work around internal controls, which sometimes meant creating fake emails from managers authorizing his transactions, preparing false documents, and intercepting warning messages. In order to conceal his enormous risk taken, he also recorded fictitious transactions that appeared to be hedges, offsetting the risk taken in the first place. For example, if he had gone long in a block of securities, he did a short fictitious trade in the same assets to make it look like the bank only suffered a small loss at worst. Kerviel used this approach repeatedly to bypass Basel II and Basel III minimum capital requirement ratio. It is important to note that Kerviel did not only lose money on his bets. In 2007, he earned 1.3 billion euros to Societe Generale. However, in the beginning of 2008, things took a downturn. The whole thing started with a miscalculation that the market would be sharply higher in late January. Instead, the market declined and Kerviel had a loss of 1 billion euros on his hands. On the 18th of January that year, Kerviel's trades were discovered. During the weekend, Societe Generale's CEO Daniel Bouton took a decision that all positions should be closed down to avoid catastrophic losses. However, over the 3-day period it took to sell all securities, the European market fell sharply, resulting in total losses of 4.9 billion euros. This is a figure equivalent to approximately 20% of the bank's former equity capital, as well as the size of the GDP in Kosovo 2011. The announcement which Societe Generale made after closing Kerviel's open positions made stock prices fall around the globe. According to Kerviel in an interview with Spiegel, the risk-taking behavior he took was not only overlooked, it was encouraged by the supervisors at his firm. Kerviel was perhaps taking some of the largest positions ever taken by an individual in excess of the company's authorized trading limits. Kerviel was then found guilty of abuse of trust, forgery, and computer abuse. He was sentenced to 3 years in jail and ordered to pay a fine of $6.75 billion and banned from working in the financial services industry for the rest of his life.
There is no guarantee that today marks the end of rogue trading era, and all that is on show is mere history. But what we can do is try to provide a solution to these fraudulent scenarios. This can be done by clearly establishing and communicating responsibility for each business activity, and segregate the duties for effective control system.
Finally, and most importantly, the management needs to clearly understand the business they manage. Internal controls, including independent risk management, need to be established for all business activities, and significant weaknesses identified by internal audit committees needs to be resolved quickly. That is it for tonight, and don't forget to catch our next episode of True Financial Stories every Friday at 8.